Hello and welcome to AI Market News by LMM. This week, we're going to dive into a really fascinating puzzle that's playing out across the financial world. See, on one hand, we have the markets, especially in the US, showing some serious strength. But on the other hand, well, the economic data is sending some very, very mixed signals. So this is the big question for us today. The markets seem to be climbing, but is that climb really on solid ground? We're going to break it all down by looking at four key areas. First, the market's strong performance. Then, the persistent story of inflation. The curious case of the US jobs report. And finally, we'll do a little health check on global business sentiment. All right, so let's start with the markets themselves. The big story this week was a pretty significant rebound in the US. And the ones leading the charge? Technology and AI-related stocks. They were firmly in the driver's seat. It really seems like after a bit of uncertainty, investor optimism, especially for tech, has made a powerful comeback. And just look at the numbers here. We can see solid gains right across the board. The Nasdaq led the pack with a jump of over 1.3%, which really reinforces that tech-heavy story. The S&P 500 and the Dow also finished the week looking pretty healthy. So on the surface, things are looking quite rosy for stocks. Now, if we peek over at the currency markets, a slightly different story is unfolding. While the euro was pretty steady against the dollar, the USD-JPY pair saw a huge move. The US dollar got a lot stronger against the Japanese yen, and that's a direct result of their central banks taking very different paths, which is a theme we're going to see a lot more of in just a moment. Yeah, that divergence between the banks is largely driven by different inflation stories, which brings us to our first major economic data point. You know, inflation has been calling the shots for what feels like forever now, and the latest report gives us a lot to chew on. And here it is. The headline number from the latest U.S. Consumer Price Index report. Over the last 12 months, prices went up by 2.7%. This is such a critical figure because it shows inflation is definitely still with us, even though it has cooled off from its highs. So what's actually driving that 2.7%? Well, energy prices are up a hefty 4.2% over the year. Shelter, housing costs, also remains pretty sticky, rising by 3%. And the core figure, that's the one that strips out the jumpy food and energy prices, is sitting at 2.6%, telling us that underlying price pressures are still very much a factor in the economy. And this isn't just a US story. Over in Europe, the European Central Bank has noted that while inflation has been a concern, they are now feeling pretty confident that it's on a path to settle around their 2% target. And that confidence is exactly why they've decided to hold their key interest rates steady for now. Okay, let's pivot to the next piece of this economic puzzle, the US labor market. And this is where the signals start to get really mixed, painting a picture that isn't quite as clear-cut as those headline stock market numbers might suggest. Let's start with the unemployment rate, which came in at 4.6% this month. Now, for some context, just a year ago, that rate was 4.2%. This slow but steady upward creep is a sign that the labor market, while it's still pretty tight, may be starting to soften up a little bit. And digging into the job creation numbers, we see that same mixed picture. The economy added a pretty modest 64,000 jobs in November. And while some sectors like healthcare and construction are still hiring strongly, we're seeing declines in other areas, like the federal government. So it's not a story of broad, booming growth, but more of a patchwork of specific strengths and weaknesses. So far, we've looked at market prices and government data, but what are businesses on the ground actually feeling? To get that perspective, we turn to survey data, which gives us a real-time health check on manufacturing and services from all around the globe. This chart from the Philly Fed's manufacturing survey gives us a great look at the current mood. Notice that orange line, which represents current activity. It's actually dipped into negative territory for the third straight month. But now look at the black line. That's what shows expectations for the future. It remains strongly positive. This tells us that while businesses are feeling the pinch right now, they're still optimistic about the next 6 months. Broadening our view with the latest PMI data, that's the Purchasing Managers Index, a key survey of business activity, we see similar signs of a slowdown. In the US, the index is at 51.8. Now, any number above 50 means expansion, but this is the weakest reading we've seen in 5 months. Meanwhile, in Japan, the index is at 49.7, which indicates their manufacturing sector is actually contracting. And this quote from Chris Williamson at S&P Global, it just sums it all up perfectly. He notes that while the U.S. economy likely grew at a decent pace in the fourth quarter, the momentum is clearly fading. growth has slowed for 2 consecutive months, and that is a trend we absolutely need to keep an eye on. So, with slowing growth, persistent inflation, and a mixed jobs market, what does this all mean for the future? Let's wrap up by looking at how central banks are reacting and what key dates we should probably circle on our calendars. What we're seeing right now is a great divergence in monetary policy. The US Fed and ECB are both holding rates steady, kind of in a wait-and-see mode, but the Bank of Japan just made a huge move, hiking its interest rate to around 0.75%. This divergence helps explain that currency volatility we saw earlier, and it adds another layer of complexity to the global outlook. Now, looking ahead at the economic calendar from investing.com, there are 3 key dates to watch. On January 9th, we get the next US jobs report. Then, on January 13th, the crucial CPI inflation data drops. And all of this leads up to the Fed's next interest rate decision on January 26th. These events will really set the tone for the markets as we head deeper into the year. And that brings us right back to our central question. We have slowing economic momentum clashing with central banks that are all doing different things. So the question we're left with is a big one. Can the market's optimism hold up in the face of these economic realities? The data in the coming weeks will be absolutely critical. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.